Mike got the VP title at 34, corner office, six-figure base, a LinkedIn headline that generated 400 congratulatory reactions overnight. Dan got passed over for the same promotion. He left that company 2 years earlier. Today, Mike's net worth sits at roughly $340,000, mostly trapped inside a 401k he can't touch without penalty for another 25 years. Dan's balance sheet reflects ownership stakes across 3 LLCs, a real estate portfolio generating passive income, and a tax structure that keeps his effective rate near 19%. Mike's effective rate, closer to 34%. The difference between them isn't talent, it isn't pedigree, it's what each man actually owns. Here is the structural reality that most high-earning W-2 professionals refuse to confront. A corporate title is not a financial instrument. A VP designation doesn't appear on your personal balance sheet. Senior director doesn't compound. You cannot depreciate a corner office. You cannot pass an executive title to your estate. What does compound? Equity. Ownership. Assets that generate cash flow whether you show up on Monday or not. Yet the American corporate machine has engineered a system so psychologically sophisticated that six-figure earners, intelligent, analytically capable professionals, consistently trade real balance sheet power for manufactured prestige. This is not accidental. This is deliberate architecture. Let's run the actual numbers. The median VP-level compensation in a major U.S. corporation sits between $180,000 and $260,000 annually. That sounds like wealth. It isn't. After federal income tax at the 32% to 37% marginal bracket, FICA contributions, state income tax in high-cost states like California or New York, and lifestyle inflation, engineered by the very corporate culture rewarding the title, what remains is frequently less than $80,000 in deployable, investable capital per year. Now consider what that capital, if consistently redirected into equity-generating structures, would produce geometrically. At a 10% annualized return, compounded over 34 years, $80,000 annually becomes approximately $18.9 million. The math is not the problem. The psychological mechanism driving this trap has a name. Gross. I call it the Prestige Liquidity Illusion. Here's how it operates. Corporate culture conditions high performers from their early 20s to equate seniority with security. The title promotion functions as a dopamine delivery system, socially validated, LinkedIn amplified, and company controlled. Each promotion incrementally increases your compensation, but it simultaneously increases your dependency. Your lifestyle scales, your mortgage scales, your tax bracket scales, and your actual negotiating leverage, your ability to walk away, collapses. The company has effectively purchased your psychological compliance with a badge, not equity. Not vested ownership, not a balance sheet line item, a badge. This is precisely what Robert Gordon's research on U.S. income distribution documented in the post-1900 era. The share of corporate wealth flowing to labor, even highly compensated W-2 labor, has contracted structurally since 1975. The share flowing to capital, to ownership, to equity holders has expanded. The executive who holds restricted stock units is accumulating ownership. The VP holding a title and a salary is accumulating dependency. Here is where this becomes deeply personal for anyone in this audience who carries a six-figure W-2. You've worked for it. The 70-hour weeks, the cross-functional alignment meetings, the performance reviews, the quarterly targets. You've earned the title, and you should feel the weight of what I'm about to say clearly. Your title is your company's asset, not yours. The moment your employment ends, the title vanishes. The business card goes blank, but the equity Dan built, that survives the resignation letter. There is a psychological dimension here that the financial media consistently ignores. high-earning professionals in the 30 to 45 age bracket carry what behavioral economists call status consumption lock-in. Your peer group has established a visible consumption floor, the neighborhood, the vehicle, the private school tuition. Deviating from that floor triggers professional and social identity anxiety. The title becomes the justification for the consumption, and the consumption eliminates the capital that could have purchased actual ownership. The institutional-grade correction here is specific, not philosophical. The actionable shift is this. Before your next compensation negotiation, whether it's a promotion, a lateral move, or an offer package, you stop negotiating the title and you start negotiating the equity instrument. In practical terms, this means demanding equity participation in one of three structures: restricted stock units with an accelerated vesting trigger tied to performance, not just tenure; a profits interest in a company-occasioned LLC if your role involves business development or client origination. This is IRS compliant under Revenue Procedure 9327 and converts ordinary income into capital gains treatment. Or, at minimum, an annual incentive plan structure with a deferred compensation election that legally shifts your W-2 income into a non-qualified deferred compensation arrangement, reducing your current year taxable income materially. None of these require a career change. None of these require a negotiating frame shift from "what is my title" to "what do I own?" Additionally, parallel to your W-2 structure, establishing a single-member LLC for any consulting, advisory, or intellectual property activity you engage in outside your primary employer creates a separate balance sheet entity. This entity can deduct legitimate business expenses, capture income at a lower effective rate, and begin building an asset column that exists entirely outside your employer's control. This isn't aggressive tax strategy. This is standard operating procedure for every sophisticated capital allocator in your building, except they're on the other side of the equity table from you. The Prestige Liquidity Illusion is the entry drug, but it doesn't operate in isolation. The reason your 401k became the default savings vehicle for your entire financial life, the reason that $18.9 million compounding opportunity gets funneled into a tax-deferred account with withdrawal restrictions, contribution caps, and limited investment optionality is a direct downstream consequence of the same W-2 dependency architecture that made the title valuable to you in the first place. Your employer structured your benefits package to keep your capital locked inside systems they influence, on timelines they define, with tax events they partially control. The 401k maximization conversation is not a saving strategy in isolation. It is the second layer of the same trap, and the mechanics behind why maxing it without understanding the structural ceiling is costing high earners more than they calculate. Click the video on your screen right now, and let's dissect exactly how the 401k contribution limit, the Roth conversion ladder, and the hidden opportunity cost of tax-deferred dependency are systematically eroding the net worth of the same VP-level earner who just celebrated a title promotion.